has been modified by many reinsurers. I mean, many of the insurers, in that they are making it tailored and suitable for the population, which has maybe increased the rate that is charged, because insurers are now looking out for the scope that is mostly demanded by the population. Yeah. So that's it. And as underwriters, I think the thing we have to do is to make sure we strike a balance between the prices and our risk management measures. Yeah.
Okay, since the topic is about strong growth, soft markets
Mm.
in the insurance space,
Yes, yes.
when it comes to an understanding of soft markets,
Mm.
could you unpack to the listeners or the people that are going to get a chance of looking at this, what does soft markets actually mean?
Mm.
Because they need to really get to know what soft markets are.
Yeah, yeah, yeah. So when we say or when you talk about soft markets, we are talking about a situation where insurers are competing aggressively on price. You get? So
Yeah.
when insurers are competing, it means clients benefit, because at the end of it all, premiums drop. If you remember, I don't know if you did some economics, but there was that law of demand and supply. You get. So once I think one factor affects the other. Once the demand increases, that means supply will be pushed, right?
Yes.
Increase. And once the supply increases, definitely the price will somehow drop, because as they say, when goods are available, definitely their price will drop. However, scarcity will lead to maybe higher prices, right? So also in our case, when clients benefit, I mean, when the premiums drop, clients get to benefit because it's easier to get cover, right? But
Yeah.
from our perspective as underwriters, that is some or that's a bit of a dangerous ground, right? For example, we are seeing pressure, especially in classes like motor and medical insurance. And on average, these are the areas that already have high claim ratios. Of course, I'll not overlook the fact that in many of the books that written by many insurance companies, you find that definitely maybe motor is actually a profitable book, but you definitely understand that the how do they call it? Is it not the severity, but okay, it's like those motor claims are usually common, like day by day they usually come up. You see, recently you saw the news there, that accident that killed very many people. So it's very easy to get many of those motor claims, though they are not so severe, but of course the frequency is so high, right? So this means that companies are stretching their risk appetite just to keep some of these accounts. For example, a company will not have appetite for a certain class, but because they need to have the account on their book, they are going to stretch themselves so that they can accommodate that particular risk. And that is really not sustainable. You get. So to me, I would like to say that cheaper premiums are basically like fast food. They are convenient now, but costly later. You get. For clients, it's a win in the short run, but for us as underwriters and for the market, it can mean weaker reserves and potential instability if claims get to, let's say, spike. You get. So basically, that's how I look at it. So soft markets mainly talk about or try to give perspective about the competition, the lower rates, the relaxed terms. You get. Yeah, something of that.
Now you've
So
talked about competitions, lower rates, which results to
mm,
undercutting.
mm,
How is this competition affecting underwriting standards? Are companies taking more risks just to win certain classes of business or risks? Or what is it? What is it like?
mm, mm, mm. So basically, remember, even with pricing pressures, our market continues to grow, right?
Yes.
For example, you can take bank assurance as an example. So when the bank, when the regulators introduced bank assurance, it was sort of a game changer. Why? Because it was easier to penetrate. Because number one is that banks already have that trust from their clientele. So I hope I'm answering the question. Or I've diverted. Am I
I'm
still on
getting
track?
you.
Yeah. So once the bankers came into insurance, you realize that um, the uptake increased naturally because these banks have trust from their clients. Why? Of course, the clients have full trust because these are the people that keep their monies. You get. So, according to sorry, according to the reports, it showed that um, bank commissions even had to shoot to up to 40% at the time.
Okay. Now, Mr. Otim, uh,
Mm,
when you look at the competition has resulted in an aspect of undercutting whereby company A is maybe taking on a risk, for example, motor, which
mm,
could be at 4% and
mm,
is insuring it at 2%,
mm,
and company B is also looking at, for example, also the same risk and is insuring it at 3%.
mm,
Leave about probably the vehicle doesn't have the discounts, the track and alarm and so sort of that.
mm.
Is it really affecting the underwriting standards? Is it increasing the company's uptake of these risks to increase on their books? What is it like? What is it like? How can this be solved so that we can have probably a standard rate whereby everyone in the industry is looking at using that rate, the business is coming in the way it is still coming in, and no one is really looking at undercutting because the industry is growing. Yes, we accept, but still it is being damaged by competition, whereby company A is looking at losing this client, and
Mm,
then this client wants to pay premiums that are convenient for them.
mm,
Therefore, that company, since this this company A is bringing in this business in large volumes, they will go by that. How
mm,
is this affecting underwriting standards in that aspect? And are the companies really taking in these big risks to make to underwrite more premiums, or they are making instead losses to take in big risks with the less rates, but huge claims coming in?
okay. So I think just like I earlier on noted that definitely it's going to be convenient for us as underwriters in the short run, but not in the long run. You know, why? Because right now, once the competition is stiff and there is, let's say, price undercutting, it means that we might go an extra mile to stretch our book and accommodate what we may not um, be in place to actually accommodate. But that can be done only in the short run. Meaning, in the
Mm.
long run, when this continues, definitely, because if you get premiums that are not commensurate to what you're going to pay, in other words, a client pays less, but of course, your exposure is still up there, it means that you cannot sustain it.
Yeah.
So for the short run, you will be able, you will enjoy, but of course, in the long run, especially when claims come into play, that's when you realize that your underwriting and your book is actually at risk. And I think the next time we shall talk about this, it's that once this happens to occur, it's the cycle goes back in place. How? That period of the soft market gets to be can I say overused, and then we go into a hard market whereby every insurer is now running away from this account. For example, I think you normally see those accounts that have very high loss ratios, and then someone is maybe let's say it's a broker, they have gotten it from company A, they want to bring it to you, and then you ask them for the loss ratios, and then they show you the book, and you're like, no, this one we cannot take it up. So that means we shall be pushed into the hard market whereby prices are high. You get it? And when
Mm.
the prices are high, it means the competition is not what? Is also not high.
Mm.
So it will go back to level. And then once the competition reduces, definitely there will be more demand for business. So people will still come back to that. It's okay. It's like a cycle. You go soft, and then soft prices you had, you definitely go back to the hard market. And then that is the thing. But overall, is that it's not sustainable. That's why it's a question to all of us as players in the industry. We might want business, which is a good thing, but definitely we cannot take every business. So I think let's write what we can sustain and not write what we cannot sustain. Because when some of these things strike us and say you wrote a business at a lower rate, and then maybe a claim comes and it has affected your reserves, you're not able to pay that claim, on a wider perspective, the industry as a whole is what is affected. Because if today, Paul, company A refused to pay a certain claim and that claim goes out there in the public, they will not say that company A has not paid this claim. They will say that insurers don't pay claims. They just steal our money. You get it? So, on
Mm.
a wider perspective, our image as insurers is at stake because we want to offer what we may not entirely accommodate in the long run.
Mm.
Yeah.
Okay. Some people might say cheaper premiums are great for clients.
Mm.
Do you agree? Or is it a short-term win that could hurt in the long run?
Some people say cheaper premiums are great for clients.
Yes. Do you agree? Or is it a short-term win that could hurt in the long run?
Um, I think it's two-sided. When they say cheaper premiums are good for clients, we definitely are clients every day. You
Mm.
also know the fact that sometimes you get what you afford. So as a client, if probably they can get a certain benefit at a lower premium, that will work for them, and they will be very happy. They'll be very satisfied. But then us as insurers, what do we remain with? The exposures, are they going to reduce? No. But how much have we gotten? Is our book making profit? How sustainable is it in the long run? Okay, because as insurers, we let's say work with reinsurers. But then if let's say a reinsurer has also limited your book to a certain capacity, and then you want to increase that exposure by underpricing, it means the next time when that reinsurer wants to give you support because of maybe the underpricing and then the claims experience, because when you talk about the loss ratio, it also speaks directly to the premiums that you've earned and then the claims that you've paid, right?
Yeah.
So it means that, let's say when you guys are arranging new treaties, your capacity is still going to be affected. So I think to us as insurers, this is not good. But of course, to clients, it's the best. It's the best option. Yeah.
Okay.
Mm,
That's very good and interesting to hear from that.
mm,
Then we look at growth drivers.
yes.
Even with the pricing wars in Uganda's markets is
Mm,
still growing. Let us
mm.
talk about why. Even with the pricing wars, Uganda's market is still growing. Let's talk about why.
Okay. I think our market is growing primarily because of various reasons. Number one, earlier on, I think this year we had a new legislation or regulation, I can call it, where we had all marine imports or whoever is importing for the importers that initially whoever would get insurance from out there, from those companies that are out of Uganda, would be very okay to import their things. But ever since this regulation came into play, I think that was February. Was it February? I think. So
Mm,
it meant that all importers are supposed to have a mandatory marine insurance from a local insurer. For as long as you're importing into the country, you must have marine insurance with either ICA, either NIC, either whichever player, but it must be a local player, right?
yeah.
And then the other thing that is fueling the growth is the emergency of bank assurance. I think if you're to look at the recent reports, the growth rate of bank assurance is extremely high. You get.
Mm,
And then also, we can also look at micro insurance and digital channels that have expanded reach, right? And then
yes.
also, we have technology that has reshaped many of our operations.
Mr. Tim, can you go on, please?
Yeah, okay. I think, Margaret, you're welcome. You can kindly mute. Yeah. So, Paul, I was also talking about the technology that has reshaped the operations in the insurance industry. For example, I know the company that I think came up with a sales tool whereby salespeople do not usually have to contact, let's say, underwriters in case they needed a quotation up to a certain limit, because that tool will definitely automate whatever they want. Let's say if it's a motor quote and maybe the sum insured is 30 millions, they'll just have to use that tool with pre-agreed benefits, and they'll be able to provide the client with the quote instantly. And then also, in terms of claims management, I think recently I know of a player that introduced a very, very wonderful app that a client may not need to actually contact people. He just has to send all the info there, the pictures, everything, and then their claim is worked on. So what does that mean? That's even with the the pressures that come with pricing, So the market is continuously growing, right?
Yes.
And one of the reasons is because of course, like I said, bank assurance, and primarily bank assurance. Why it's growing is because you and I know that you keep the money in the bank. So if someone from the bank approached you, you definitely have that trust already because these are the people that keep your money. So if someone told you that, okay, we have maybe a life insurance policy that does A, B, C, D, because your money is kept with that bank, you'll be like, okay, I can sign up for this, you know? And then, two, the fact that they have a big clientele, it means that they can tap into that clientele. So
Mm.
whoever, let's say, signs up with maybe Centenary, Equity, all those people can be reached by that very particular bank. And that would be easier for them to sign up. And then also, the marine insurance has also retained billions in the local premiums simply because all importers are now buying insurance from the players locally, right?
Yeah.
So basically, I think that's it. And then, of course, micro insurance. You've seen, I used to work with a company where they had a particular product for safe border, which meant that all border riders could afford that because it was very cheap. And then the fact that they were using a brand that is already known, which is Safe Border, it was easier to increase their outreach.
Okay.
Yeah.
You've talked about mandatory marine insurance rule that has kept billions in local premiums. How
Mhm.
much of a game changer has that been, especially in our industry?
Well, I think primarily I may not be able to quantify that, but I think I'll look at the annual reports at the end of the year. But at least what I can confirm is that because remember, the marine portal works as a pool. I think you know how the pool works, whereby let's say
Mm.
there are those apart from these clients that come in through brokers, agents, there are those direct clients whereby somehow it works like I think like the way you see the commercial that they write the risk and then particular insurers take a certain portion of it. So number one, what that means is that each insurer at least gets a portion and that is back to us. But also not forgetting the fact that all the monies that were going out of the country as people were importing are now channeled back to the country. You can wonder
Yes.
how much that is. So that alone is a very big game changer. It's what is pushing the numbers. And believe me, let's wait for the annual report and see how it comes out. But I can assure you that if we make comparison to what we wrote last year as an industry in, say, marine insurance, and what we shall write this year, it's going to be a very, very huge difference.
Actually, we'll look up to that next year.
Yeah.
Then, when you look at digital uptake, we've seen
Yes.
there's been introduction of digital stickers
Yes.
in this industry that has really been championed by the regulators.
Mm.
How do you see technology in shaping Uganda's insurance industry, especially when it
Um,
comes to digital third party? And do you think that people are really looking at embracing it? And do you think that we are going to tap into seeing that premium growth is really actualized?
well, I think the answer is yes. Why? Because number one, as an industry, when we go into digital, uh, in most cases, I think we've advocated for ESG, that is environmental social governance. So when you go into the digital stickers, number one is that we shall be also protecting the environment. Because remember, we used to print these stickers and definitely many of these stickers, when they expire, everyone just dumps them whenever they want. like this tax. Actually, people call it a tax. But then number
Mm.
two is that I think it's also going to um, improve on how we operate as insurers, because if you issue a digital sticker, it means anywhere, any person who is in any part of this country does not need to directly go to an insurer or to go to an outlet to get a sticker like it has always been. So, which means that the comfort of whatever they are going to be able to get their digital stickers just in the dial of their phone. And then two is that definitely uptake will increase. Why? Because at least from my understanding, and I get to know that there's a small reduction that the stakeholders, I mean the clients, have been incurring, which is going to be affected. And that is, since we are no longer going to print them, at least the information I got, I don't know if it's yet authentic, but the sticker fees are going to substantially reduce. So meaning a person who was paying a certain amount, obviously it may not be so much, but it will not be as expensive as it was. And then two, I think it also motivate people to go digital so that they can embrace the digital change that is definitely in each and every part of, I think in each and every industry. So definitely, I feel it's a yes for me. Obviously, the digital sticker is going to do a lot, starting from us, the insurers, because there are those times whereby maybe someone does not have a sticker on in their car, and at some point they feel like they do not have insurance, third party, even if the car was already running. So that will also give them the assurance not to say that I do not have insurance, even if the car is running. And then also it will maybe reduce the frustration from the public, because there used to be some bit of, can I call it manipulation, where someone does not find you with a sticker. I mean, our people on the road, they'd be like, you don't have insurance. But here you're just going to be like, okay, I found it. This is it. Yeah. And then, of course, for the premiums, yeah, they're going to substantially increase also. Yeah.
Okay. Now, still about the digital sticker uptake.
Mm,
Do you think we are ready for it? And if you're ready for it, when should we officially kick off?
um, well, that is a very hard question to answer, of whether we are ready or not. But I think all the stakeholders in this carried out some research, and they felt that maybe the industry is ready. Now, the
Mm,
readiness would be in one way or the other, basing on, I think that would be on a company,
basis.
bring it down to the company basis, because obviously we are not all equal. There are those companies that have already embraced it, and then there are those that are still, of course, trying to embrace it. But definitely, I am one person that thinks that when change comes, the time it has come, it's the time it was supposed to have come. So I feel we are ready. In case there are some loopholes, I feel we can still find ways of closing them and make this operate better, and ensure that each and every stakeholder gets to participate actively in this. Yep.
Okay, that's well articulated. Now,
Mm,
when we let's look at risks behind growth. This could be
mm,
in premiums.
mm,
Growth can be a mask which can be at times fragile.
mm,
What kind of fragile are we talking about here when it comes to growth in premiums?
mm. Um, okay. So we all know that, of course, naturally, growth is exciting. Yeah.
Yes.
For example, I'll give a common example. Um, if someone got a new job today, there would be an excitement of it. But of course, with growth um, comes responsibility, and then obviously, when there is responsibility, there are those points or times in peak where you will, of course, feel a bit frustrated, that kind. So here, how we can translate it is that, if everyone is trying to chase numbers in the industry, it's easy for us to miss the cracks that, form beneath the surface. For
Mm.
example, medical claims rise very fast, motor losses are very, very consistent. You get, and basing on our, of course, the unpredictability of our, let's say, climate, you know that at one point, one major event could easily shake, you know, any odd of our balance sheet. For example, just imagine an insurer who is insuring. Recently, you saw those floods. Just give an example. If an insurer is the one that is insuring all those shops on that street, you get, that's already an accumulation. So at some way or at some point or the other, they'll be exposed. So what does that mean? That as these margins get tighter, some insurers may start to feel the heat, especially those that are discounting the premiums so heavily. You get. So if the industry does not maintain maybe say strong capital and then strong reinsurance structures, uh, probably their financial strain is going to be a bit inevitable. You get. So as we try to get excited about the growth, we celebrate the growth, we also need to stay alert as an industry. You get it. We have to remain strong, not just in premium numbers, you get, but we should have that ability to pay claims when they come. So, in other words, our growth should reflect on our ability to make sure that we stand when that time of losses comes in place. Yeah. Paul, I cannot hear you. Have you muted?
Now, given you can hear me now,
Yes, yes, yeah, I can.
given how unpredictable climate events have become,
Mm,
especially that even recently we've had people facing flood risks
mm,
downtown, and shops have been affected.
mm.
How are local insurers really financially ready to handle these big shops, especially if they are to have micro products that focus on the mwananchi, the person that operates those different shops downtown? How
Mm.
are they really ready to handle such shocks?
I think primarily, maybe if I start from the regulator's side, I think as a regulator, he should make sure that he tries to tighten solvency controls. You get, meaning that according to how the company is performing, what are their capital reserves? What is the least they should have? I think that is something that the regulator may be or may need to be concerned about. And then two, as an industry or as a company, we should make sure that we have proper reinsurance structures that will give us that financial muscle in times when we get exposed to these very huge claims. And then also, of course, as a company, you make sure that you maintain a very, very strong capital reserve. That is the only way. And that still goes back to the fact that you do not have to discount premiums so much. You have to make sure that every risk is sufficiently priced so that you can be able to get a premium that speaks into the risk itself. Yeah, that's, I think that would be, I feel that would be something that would enable us insurers to still stay in the market. Yeah.
Then when we have to look at the way forward and building sustainability, and where do we go from here? The premium growth, the climate risks, and all those aspects. And you've talked about growth, softening markets, which is not a contradiction. What do you mean by crossroads in this aspect? Because a person who would be there watching this or listening to this could wish to know what you meant by crossroads.
Yeah. Okay. That one is also a good one. So, when I said growth amid softening is not a contradiction, but a crossroads, I meant that the industry is standing at a decision point. This is the time where we chase growth at any cost, like at any cost. You get it. So, but then we also have to focus on sustainability, like, in other words, sustainable growth. It's like if we put it in our local setting here, assuming especially us whom they call the Gen Zs, we love good life. You find someone that buys a car, you get, and yeah, everyone is like, okay, the guy has a car. But then this guy has bought a car that he cannot even fuel for the entire month. You get it? So it reaches a time where the car itself is now a liability of sorts. So that's not what we want to have in the industry. We want to have sustainable growth where whatever we do speaks into the value we create out there. Where we take on risks and we are like, okay, we are going to get this risk. And because we've done the right pricing, because we've done the right reinsurance placement, we are going to get profitability out of this book. And should any loss come at any point, we are able to pay that loss. And when we pay that loss, it speaks into our publicity as an industry. That, of course, company B has paid this claim, company A has paid the other claim, insurers are doing a good job. We shall not hear any stories of insurers just take money, they just steal our money, they do not pay claims. You get it?
Yeah.
And then also, I think, what else did you talk about?
Still further is what decisions must be made in this industry so that what you've talked about is really addressed.
Okay. I think the currently maybe the biggest challenge we have in the industry is to bring back the pricing integrity. I mean, to be in an industry where we do not have to undercut to get business. You get. And one thing that I feel can solve this is use of technology in a way that, for example, if we employed, let's say, AI, if we employed data analytics, so we can make underwriting decisions a little bit sharper. In a way that, of course, when you employ technology, you'll definitely have a cap for each and every maybe risk that you take on as an industry. And I think this should be or can be done at an industrial level. If we employ AI, if we employ data analytics, I think we can achieve this. You get. But also, we can also agree that even if we talk about technology and AI alone, we cannot, technology and AI cannot like save us. So as an industry still, we need high literacy levels, both within us as stakeholders, I mean, us that work within the industry, and then also among the clients. Like, we need to make sure we educate ourselves. We need to make sure we go out there and educate the public and tell them that insurance is here to do A, B, C, D, and you do not need to get a lower price because you want this. You need to get a substantive price so that when you get a loss, this is what we are going to do for you. And I think I always thought about the fact that as an industry, we have to now rescale and go back to the roots. How? Paul, if you take a flashback, I don't remember myself studying about insurance in primary. Even the time I studied about it, I think it was in my senior 4, and it was just like a snippet. It could have been like 2 days where I did commerce in S4. So our teacher brought it in and just took us through just the basics. What is insurance? These types of insurance, life insurance, those things. But then if we go back to the roots and we try to embed the curriculum and have insurance as maybe a small section of the curriculum, it means that we shall increase awareness, we shall increase our literacy levels right from the time when our populations are still young, so that they grow knowing that insurance is a risk management measure. Insurance is a buffer that we all need. You get it? Yeah. So I think that would be a thing that we need to do as an industry, and maybe push through our regulator, push it to the government to maybe implement it so that people get to really understand why they need to buy insurance, the value, and then that means we shall be able to overplay this mentality of people buying insurance and buying it cheap. You get. So
I
yeah.
get you. Now, the regulator has been encouraging the adoption of AI, technology, innovations, and I, for one, have attended seminars that are focusing on AI. Do you think technology can help bring back the pricing discipline, especially when we are underwriting different risks, either complex or not complex? And should we embrace it?
Well, yes, we should. But also just to remember that as we embrace technology, just like I said, we also need to increase our literacy levels. Literacy levels in the industry, literacy levels out there in the public. Because if you have an industry that is well informed, I mean, you have underwriters that know how to make underwriting decisions, know how to treat a risk the way it should be treated. It means we are hitting two birds with one stone. We are bringing back integrity into the space, but at the same time, we are also using less energy out there to the public. It means that even the people out there will come to buy insurance knowing that what I'm buying is value quality over cheapness. So, and that will entirely help us as an industry. Of course, technology is going to do so great, but believe me, if technology is alone without literacy, we may not do as we are supposed to do, because technology also relies on us, even if we also rely on it, but it also relies on our integrity. So, most importantly, I think, yeah.
Okay, you've talked about public awareness, literacy levels. When it comes to the awareness of insurance,
Mm.
I think the the industry has left all the responsibility to the regulator to do the awareness issue. Yet this could be done as a pact whereby all the companies participating in the industry make people aware of. But it seems that even the industries, I mean the companies that are in the industry, they are not actually fully involved in the awareness, because I believe companies could have been enforced, or there could be an enforcement of them
Mm.
giving themselves out there. In which aspect? They should go to schools, they should go to the public. But even you see a few companies running ads on television or on billboards about insurance, and still
Mm.
the language we use to the layman to transmit insurance
Mm.
is really complex for the layman to understand the importance of insurance. What
Yeah.
could be your take on that?
Um, Maybe to start with, you know, sometimes these companies have budgets, let's say their marketing budgets and everything. But most importantly, at least recently, I've seen companies that involve in certain causes. For example, you find maybe there's a Rotary Cancer Run, and then company A says we are going to buy this amount of maybe how they call them. Um, I've forgotten the word, but campaigns like maybe Miss Tourism, and then a company comes and says we are going to provide ABCD. Okay, they try to increase their publicity that way, but of course that also speaks into their different budgets as the different stakeholders. But then also, I think maybe the best approach would be, as the regulator is trying to increase publicity out there, trying to make sure they run as many ads, maybe they would partner with all the players. And I don't know how this can be done, but I know it's not
Mr.
an easy one.
Otim, to cut you short on that,
Mm.
on the aspect of climate, the unpredictability of the climate, whereby we experience floods affecting people downtown.
Mm. Mm.
Don't you think that is when the players could have come out and go down there? They explain to these traders with the collaboration of the regulator the importance of insurance, because across the news, across what happened, all the period, for all that time, I didn't
Mm.
see any one player try to get themselves involved in educating people the importance of insurance. And yet, people out there, the players, sometimes they think people know the importance of insurance.
Mm.
Yet, people, for them, think insurance is about theft, it's about taking their money. Don't you think that is when we could have come full board, the players,
Yeah.
and we say that since this has happened, let us become an eye opener.
Yeah.
We explain to these people the details of insurance, how it can help them, how it can put them back in the position they were in before that occurrence.
Mm.
What could be your take on that?
Well, I think that is a very, very brilliant idea. Actually, when you spoke and highlighted about it, that's when my eyes also opened and I realized no one actually came up, nothing. Yet it was out there in the news. But also, I think somehow, because when you look at our insurance capacity and our insurance appetite, you'd realize that many of our company books that we okay, many of the risks that we write, we realize that I think when it comes to such places that are so obvious and prone to floods, I think insurers try to shun away from them, and that could be the reason. But I think if we are to look on the positive bit, we can leverage that moment, and as an industry come up. Personally, I feel in case of such risks, I know this will be hard to achieve, but I feel like we need a pool. Like you see the way you have the Comesa pool, we need a pool that uh, strictly works on such risks. Like we can maybe tie them to fire and floods, especially floods, and that could work for the people downtown there, because most of the insurers would not really want to take up such places because they are too obvious. In other words, even yourself as an underwriter, if you were given chance to go and maybe just make a survey around the place, you definitely would not want to have such a risk on your book, because you definitely know the loss experience is going to be up there. But on a lighter note and a positive one, I think we missed out on that as an insurance industry. I think that was the time we were supposed to get these people out there. Maybe, of course, sometimes, okay, the companies do have different budgets per se, but at such a point, that's the time you would do some sort of corporate social responsibility, and maybe say, whoever has lost, let's maybe accommodate them up to maybe 20 million or up to 10 as an industry entirely. But of course, we are still not up there. But I know if we continue gearing up to this, I think we can provide a solution to even the people downtown there, especially those that will be affected by those floods. And maybe also, when we employ the surveyors, they can also advise and be like, okay, can we improve ABCD? Can we do ABCD? And that, in a way or the other, improves also the people downtown there, because it means that they will not be able to face the floods anymore. But maybe on the other point is that we can also look at, as we look at the industry entirely, we can also look at maybe our governance system. Sometimes the players may not want to directly involve in some matters that seemingly may not be well resolved, because, as you know, if you read many of the treaties, they are guided by the laws of Uganda, right? So it means
Yeah.
that each and everything they have to do, each and every risk exposure they have, it must be in line with the regulation, and of which if some things are not well aligned, you may not want a player, or a player may not want to be part of it. Yeah, because of obviously, as the insurance companies, they have the shareholders who expect them to also deliver at a certain point. So, but you've highlighted on it, and I think it's a very important aspect. And we overlooked this as the entire industry. So, hopefully, IRA can look into such things. These are opportunities for us to sell, opportunities for us to also educate the people and increase the literacy levels. Yeah.
True, true, true.
Mm,
Then going back at the point of uh, AI technology,
mm,
I've remembered something that I wanted us to point uh, briefly talk about is about the impact of technology, AI, and then the risks that are embedded in technology. Because I've come to a realization that I don't know where there is a company that is underwriting cyber, but
mm,
when you look at growing premiums,
mm,
I think that could be a virgin area where we could really look at cyber. Because when you look at an organization like NSSF,
mm,
and they are holding huge volumes of data for people and
mm.
their money.
Yeah,
You look at an organization like Stanbic Bank,
yeah,
Standard Chartered, the Centenary Bank, whereby I had some time where that they were hacked. Have we taken the initiative of exploring that aspect of cyber to underwrite it in our market so as to grow premiums? Do we have the expertise to do so?
um well, when it comes to there are some classes, especially those liability classes, where locally I think many of our insurers may not support, and you realize that many of the treaties cannot support. But obviously, we can rely on the reinsurers out there and provide these covers. Though that means that, of course, some of the premiums and majority, or a bigger percentage of the premiums, will definitely go out. Yeah, but of course, as the industry grows, it means that, of course, capacity also grows. So I am very optimistic in years to come, we shall be able to have capacity as an industry. But what I know is that currently we do not have capacity for cyber. At least I've worked on a cyber policy, a big one with one of the banks, and the reinsurers were actually not here. So it's like we fronted the risk. We were only getting a commission on it at that time. So that means that because we want to retain as more premiums, we need to grow capacity to make sure that once we have um, a cyber risk, we as an industry can retain part of the premium. Of course, retaining with the fact that in case of a claim, we are able to pay. But that is still something that is a long journey. But definitely with the growth, I know we shall reach the time where we have the capacity. Yeah. And then the fact that I think last year, not last year, this very year, you had that the Lions opened up at least next to our neighbors here in Nairobi, I think. They have
Yes.
an office. It means that the fact that they have an office, it's an opportunity for us to also utilize the capacity easily, because when they say when there is presence, I think there is impact. So the fact that they will have an office in East Africa, it means that East Africa will also have capacity to at least get access to some of the risks that are written by the layouts. And I think that's not going to take so long. So as a market, we can still remain optimistic, continue working within our book, and make sure we perform well on our book so that as eventually the book grows, our capacity grows, and then we shall be able to retain more premiums.
Thank you, Mr. Otim Ivan Pius, for the discussion. And as we close, I could like you to give a piece of advice to the insurers
Mm,
and another one to the clients who are the
mm,
consumers of insurance.
mm.
And what could you tell them as we end this discussion?
Well. One thing is that our industry is still growing, and the first thing that we have to do is to make sure we increase our literacy levels. Let's make sure that we understand the risks. Let's also make sure that the public gets to understand what we do and why we do it. Yeah, so basically my advice to insurers is let's increase our innovation, but also not compromise on our discipline. Yes, we want the business, but let's also keep up the discipline because it's what will keep us in the market. And then to the clients, I think they should look beyond the lower prices and look out for value, look out for reliability, and also the insurer's ability to stand when it matters most, and that is the time of claims. So with that, I think our industry will grow and we shall write trillions and trillions, who knows, even $1 trillion. Yeah. So,
Okay, thank you for the time you've given us here on the Insurance Focus Network Africa.
mm,
We wish to discuss on different topics here, and if time allows, we'll still invite more new guests. We encourage people to like, subscribe, and share this. We are going to put it on different platforms so that we not only gain, but everyone gains and the industry gains. And also we encourage people, especially those ones that see insurance as a theft or an area where they are going to steal their money, to see the brighter side of it as a safeguard or a safety net, so that we can grow not only as an industry, but also the consumers get to grow, because there is no way we are going to grow apart from the insureds or the people, the consumers get to jump on board. Thank you so much, team. I wish you a good evening.
thank you so much to Paul for hosting me, and good evening to everyone.
It's a pleasure.
Mm.